This video will help you understand how the Expeditors Employee Stock Purchase Plan works. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. As one of the largest logistics companies in the entire world, Expeditors has a number of great benefits that their employees are going to want to be aware of, in particular the Employee Stock Purchase Plan. They're also a major employer here in Seattle, so I'm hoping this is helpful for folks in kind of greater Seattle area. In this video, my goal is to break down the Employee Stock Purchase Plan so you can be more informed and make a more informed decision before deciding to enroll, or after you've enrolled, understanding what comes next. Also, the explainer videos on the Fidelity website don't offer a tremendous amount by way of helpful tax information, so I'm hoping to make sure we cover all the nuances in today's video. So let's jump in. So if you're looking for more general information on employee stock purchase plans in general, you can check out my previous two videos that explain the differences between qualifying and disqualifying dispositions, lookbacks versus non-lookbacks, discounts, etc., and I'll link those two down below. We might use some terminology in this video that I'll do my best to explain as we go along, but if you're looking for more of a deep dive into the nuances behind employee stock purchase plans in total, again, check out those videos below. Since 1988, Expeditors has offered their employees to enroll and participate in purchasing company stock at a discount. Fundamentally, the offering of an employee stock purchase plan offers employees a unique benefit that isn't open to other investors on the open market. And by definition, that's purchasing stock at a discount. What this does, in summary, is it allows every dollar invested in company stock to stretch further than if you were to take that same dollar and invest in company stock in the open market. For example, let's say your employee stock purchase plan is offering you a 10% discount on buying company stock. And let's say the stock for whatever company we're talking about is trading at $100 per share. If we both start with $100 and I go into the open market to go buy this company's stock, I'd be able to buy one share at $100. Whereas you, having access to an employee stock purchase plan at this company, would take that same $100 and rather than paying $100 per share and getting one share, you'd pay $90 per share given the 10% discount, and you would purchase 1.11 shares. At the end of the day, my account will be worth $100 and your account would be worth $111. So we both started with $100 and you ended up with more money. Now let's touch on the Expeditors Employee Stock Purchase Plan. So from a high-level overview, they offer a 15% discount on the purchase of Expeditors stock. You as an employee are permitted to contribute between 1 to 10% of your compensation, not to exceed $25,000, and that's the IRS maximum. This essentially means if you make $300,000 a year, the maximum you can put into the employee stock purchase plan is $25,000. And if you make $100,000 a year, the maximum you can put in is $10,000 or 10% of your compensation. Basically, the goal is not to let folks who aren't making a tremendous amount of income to over leverage themselves and buy too much company stock. Expeditors also has an annual offering period, and that's a little bit unique. A lot of employee stock purchase plans out there will allow you offering periods that last 6 months or every quarter, but Expeditors is an annual offering period, and I'll explain what that is in a second. Essentially what that means is payroll contributions that go into the employee stock purchase plan start on August 1st of one year, and they end on July 31st of the following year. You can't change your contribution during that annual period, so you have to make sure you've budgeted appropriately because you're making a one-year commitment. Expeditors also offers an annual look back, and that's also pretty unique, whereby during that offering period, if the stock price is lower at the beginning of the offering period, so August 1st of the particular year, compared to where the stock price will be at the end of the offering period, July 31st of the following year, whichever stock price is lower, which generally will be the August 1st beginning offering period price, that's the stock price that Expeditors lets you buy the stock at plus the discount. Now, of course, if the end of offering period price is lower, then they'll give you that price minus the discount. But generally, when stocks go up, you'll be benefiting from looking back to the beginning offering period price. Mathematically, this essentially means you get to look back in time every year and say, hey, if the stock price has gone up, sweet, I'm going to benefit from a lower offering period price, a discount, which essentially just means you result in more shares purchased for the same dollar amount. So not only do you get a stock discount via the 15% we talked about, but you also get a super duper discount because you're looking back to the cheaper of the two prices and then doing the discount. Now, super duper discount is not a technical term, but hopefully you can see the value in being able to look back in time. Now, once you have access to the stock, which would be August 1st in the year following the August 1st of the beginning of the offering period, aka the offering period goes from August 1 to July 31st, and then after that July 31st date, you then have access to the shares. Depending on when you choose to sell the stock, you're either going to fall into qualifying or disqualifying disposition rules. I'll link above to my previous video that explains the different dispositions a little bit more in detail. At timestamp 2 minutes and 20 seconds, that's when the explanation starts. To keep it very simple, a qualifying disposition is defined as waiting at least 2 years from the beginning of the offering period and having possession of the stock for at least 1 year. If you meet both of those definitions, when you go to sell those shares, you'll have met the rules for a qualifying disposition. By definition, a disqualifying disposition is anything other than that, which generally looks like once you have access to the stock, not holding it for at least a year, or holding it for a year but not letting it have been 2 years since the beginning of the offering period price. We'll touch on the tax differences in just a quick second, but to keep it simple, Expeditors, since their offering period lasts an entire year, the only accounting you need to do in your head is, have I had access to control the stock for at least a year? If the answer is no, then when you sell it, it's a disqualifying disposition. And if the answer is yes, then you'll have met those qualifying disposition rules, because all you need to do is hold the stock for 1 year. And by definition, with an annual enrollment period, you'll have held the stock for 2 years since the beginning date of the offering period. The reason disqualifying versus qualifying disposition matters is because it dictates how much of the total gain you received from the discounted look-backed price to the fair market value on the date that you sell it. It'll dictate how much of this difference is considered ordinary income or long-term capital gains. And without getting too deep into the nuances, you'd much rather pay long-term capital gains tax on every dollar than ordinary income tax on every dollar. Generally, ordinary income is going to be taxed in the 20 to 30% range, and long-term capital gains for the most part will be at 15 to 20%. At Expeditors, to meet the qualifying disposition rules, you just have to hold the stock for 1 year. If you held the stock for 1 year, then you're going to pay ordinary income taxes on the dollar value of the discount that was given to you, and everything else is going to be considered long-term capital gains. However, if you sell the stock in less than a year since you took possession of it, well, then you didn't meet the rules for qualifying disposition. You'll fall into disqualifying disposition rules. And what that means is the dollar value of the discount, that's considered ordinary income. Again, there's nothing you can actually do about that. That's considered ordinary income. The difference between the end of offering period price and the beginning of offering period price, that will also be considered ordinary income. And then, coincidentally, since you didn't hold the stock for at least a year, you're going to get hit with short-term capital gains tax on the difference between the end of offering period price and whatever you sold it for. So unfortunately, a disqualifying disposition through Expeditors results in the entire value gained being considered ordinary income taxable. Let's do a quick walkthrough using some real-world potential stock prices, and it'll explain the differences between these two, as well as some tax accounting. At the end of the day, if you don't like math or you don't want to see how the sausage is made from a tax standpoint, just skip ahead to this section. Otherwise, let's head to the whiteboard. Let's walk through a quick example to illustrate the difference between a qualifying and disqualifying disposition from a tax point. So let's say it's July 1 of 2024, and you're looking to invest in the employee stock purchase plan from 2024 to 2025. That means starting on August 1 of 2024, you're going to invest in the employee stock purchase plan all the way until July 31st of 25. And let's say you've decided you're going to invest a total of $20,000. And Expeditors is going to look at the stock prices on both of these dates and pick which one is lower, and then give you a discount, a 15% discount on that share price. So let's say on August, the share price was $120 per share. And let's say in July, the share price is $200 per share. Expeditors is going to look back at the $120 per share price and give you a 15% discount on that, which is $102 per share. You've invested 20 grand, so you take 20 grand divided by $102 per share, and that means you purchased 196 shares, which has a fair market value of $39,200 based on this share price. So you invested 20 grand and you now have $39,200. Let's cover a disqualifying disposition as an example. Let's say it's January of 2026 and you decide you're going to blow out of all your stock. Well, you invested 20 grand. Let's say the stock price in January is $210 per share. That means your account is going to be worth $41,160. And that's because you bought 196 shares and every share is worth $210. And since you invested 20 grand, and the value is $41,160, that means you need to figure out how much of the $21,160 of gain is going to be considered ordinary income taxable or long-term capital gains taxable. Well, the cheat code is it's all going to be considered ordinary income taxes and short-term capital gains. So the accounting is actually pretty simple. It's just this number times your ordinary income tax bracket. But I'll break down the sections so that you understand how I came up with that number. Well, given a disqualifying disposition, that means you didn't hold the stock through Expeditors for at least a year. That means the discount dollar value, this 15% dollar value, is going to be considered ordinary income taxable. Now, there's actually nothing you can do about that, even if it was a qualifying disposition, but just understand the first batch of taxes that will apply is ordinary income taxes on the dollar value of the discount. So the dollar value is actually $18 per share. That's the 15% here. And since you have 196 shares, that means a total of $3,528 is going to be considered ordinary income taxable due to the discount. So this is the dollar value of the discount here. Then there's a difference between the end of offering period price and the beginning of offering period price, which is $80 per share in this example. And that's where I take this 200 minus this 120, and that's $80 per share. And since I have 196 shares, that dollar value is $15,680. This is also ordinary income taxable, and it's the difference between the offering period prices, aka it's the value of the look back. That's going to be considered ordinary income. Then, since I got the stock for $200 per share and I sold the stock for $210 per share, then I do $10 per share and I have 196 shares, which is $1,960. So this is also going to be considered short-term capital gains, which is taxed the same as ordinary income taxable. So you can simplify and just say it's all ordinary income taxable, but this would be considered short-term capital gains tax right here. And as you can tell, if you add all this up together, it pretty much equals the entire value minus some rounding for the difference between what you paid for things, which was 20 grand, and what you sold things for, which is $41,160. All that's going to be considered ordinary income taxable. If you add all that up, which is $21,160, it's going to be subject to ordinary income taxes. Let's assume you're at a 22% tax rate. That's going to equal around $4,655 in taxes that you'll owe the IRS because you decided to sell and cause a disqualifying disposition. $4,655. Now let's go back in time a little bit and say you decide not to sell out of all your stock in January of 2026, but instead you wait at least a year. So we'll fast forward and say it's September of 2026. So September of 2026, and now you want to sell out of all your stock. Well, again, you paid 20 grand, so 20 grand is your basis. And so now we have to figure out what's the fair market value today, and then what's the gain between what you paid and what you're getting. And that will dictate how much in total gain we have to count as either ordinary income tax or long-term capital gains. So since we're going to wait a year since the stock landed in our account, at least a year, then it's going to be considered a qualifying disposition. Qualifying disposition. So now we get much more favorable tax rules. And let's break that down. Let's say the stock price, just for simplicity, is the exact same. It's $210 as the previous disqualifying disposition example. So we've got $210 per share. Therefore, the math is going to be the same on the total value of the account, which is $41,160. And so now we have to figure out, okay, this $21,160 of difference here, how much is going to be considered ordinary income, short-term, or long-term capital gains? Well, we already did the math on the 15% ordinary income tax on the discount, and that's not going to change between disqualifying or qualifying dispositions. And that math is 3,528 is going to be considered ordinary income taxable. And that's the dollar value of the discount. Then we have to figure out the difference between the beginning of the offering period price and the fair market value at the time of sale. The nice thing about the qualifying disposition is it takes everything else and considers all of that long-term capital gains. So you can do some simple math and reverse engineer what that would be, or we can do the math the hard way, which is basically saying, okay, 210 minus 120 is $90 per share. $90 per share times 196 is $17,640. So $17,640. This is all going to be considered long-term capital gains, which generally is going to be somewhere in the ballpark of 15 to 20% in taxes, which compared to ordinary income is almost always a much smaller tax hit. Either way, you add these two numbers up and you get this total gain here. And as you can see, there's a much lower tax liability compared to the previous example. In fact, if we do, let's say, a 22% tax rate on this and a 15% tax rate on this, that equals total taxes of around $3,422 in taxes, which compared to the disqualifying disposition was, let's see, $4,655 in taxes. It's kind of our estimate here. And so there's a difference here of about, I don't know, 1, 2, 3, 3. There's kind of a difference here between a disqualifying disposition and a qualifying disposition. Now the math isn't crazy different, and that's because I kept the stock price the same. But as you can see, you obviously want to pay less in taxes when you can. And of course, having a qualifying disposition makes a ton of sense from a tax perspective, especially when you start adding these numbers up if the stock price does go up quite a bit. So general best practices with the Expeditors employee stock purchase plan is to hold the shares for at least a year. Sure, you could argue that the stock price might go down in tremendous fashion between the day that you have access to the stock and then when you sell it, and that's a very real concern. If you aren't overly concerned about that, however, the tax benefit in waiting the year is totally worth it in my opinion. Barring any unique circumstances where maybe you have super huge liquidity needs or your financial situation has drastically changed since the date you enrolled, I would highly recommend trying to hold on to the stock for at least a year. Personally, as a index fund, efficient market hypothesis sort of investor and wealth management advisor, I'm not a huge fan of clients holding on to their company stock for any longer than they need to, or in any size that would put their financial situation at greater risk than it needs to be. So I generally advise clients sell out of the stock, or at least have a plan to start selling out at some point in the future before you just close your eyes and wake up a decade from now and half of your net worth is in Expeditor stock. So from a calls to action standpoint, I'd highly recommend coming up with a strategy of how you're going to divest out of this plan, at least in some degree, before you start investing. It's definitely pulling teeth with clients when they have invested a tremendous amount in company stock, and then now it's a big problem in their financial plan. It's a lot of risk, and we have to unravel the concentrated stock positions, which unfortunately, if the stock has done really well, means that they're going to be pretty heavily taxed to get the money back out. Granted, it's going to mostly be long-term capital gains, so it's not a huge tax hit per dollar, but it still is sizable taxes. And if we can diversify ahead of time, then we don't have to worry about selling out of highly appreciated stock at some point in the future. Next call to action though is if you are going to start selling out, make sure you've at least waited the 1 year. That way you benefit from qualifying disposition rules and you save yourself a bunch of taxes. Last call to action is enrollment in the plan is due on July 17th, if not earlier. So I'd highly recommend if you're considering getting into the plan, you look to do that sooner rather than later because there are no exceptions to missing the July 17th deadline to enroll. And then your payroll contributions would start August 1. So hopefully that was helpful. If you have further questions, drop them in the comments below or get in touch with the website. We'll help you get squared away. Have an awesome rest of your week. We'll talk to you later. Bye.